House to Home, presented by Remax Diamond Realty.
Half a day, everybody, here on House to Home, where Liz, Gina, and myself, Jason, we like to give you certain things. We like to give you information. We like to give you knowledge. We like to give you options. We sometimes even like to give you coffee and cupcake tips, which we may do at the end of this episode. But right now, we're actually doing the third of those ladies. So we would like to give people the benefit of choice. And when you have options, I'm sure, Gina, a lot of people, as we say on the show, it is good for your credit to get into debt and then pay that debt down. And certainly if you own a home, that's the American dream. That's a Guamanian dream. And it has the benefit of equity. But most people just think, okay, I got to wait until interest rates are abysmally low and then I pounce at that and everything. And people just like to go for fixed rate because if you're someone like myself, risk is really, really scary. But you actually have a fairly reliable alternate plan for people to consider, right?
Well, we found ourselves in the situation where people who a year ago qualified at 4% or even below 4%, right, Liz? It was below 4% about a year ago. So we're working with customers that a year ago, they qualified because the interest rates were below 4, and now we're at 6.25%. And for some families, that's enough to kick them out of the ball game. They no longer qualify for either the price range that they need to be in order to buy, or the home that they were looking at, they no longer qualify for that particular property. So, Liz and myself, we've been shopping around for the benefit of our customers. And some of the lenders have reached out to us and said, hey, listen, we've got these adjustable rate mortgages, which people haven't really been using for a long time, because there was a point where the adjustable rate mortgage interest rate was higher than the fixed rate. But we're back into the ball game of adjustable rate mortgages may be the way you want to go. And some of these lenders reached out to us and said, listen, we've got adjustable rate mortgages at 4%. Some lenders have them at 5%. But of course, if you're interest sensitive, if you're interest rate sensitive, you're going to go with the lender that's going to offer you the lowest interest rate, because as the interest rate goes down, your buying power goes up. Or maybe you're back into qualifying for that home you've been looking at 4%. And we want to promote the idea that might be a very, very solid alternative.
Liz, I think a lot of people, and okay, I'm speaking largely as myself, as someone who can be a real ignoramus about this kind of stuff, right? I think of, because I grew up, like I would go to, and I'm dating myself here, I would go to like Gibson's or to Townhouse or to Sterling. That's how old I am, right? And you go there and you'd look, like, say if I was trying to buy a shirt, right? You either figure out if there's a sale, and then you immediately like seize the opportunity if the item that you're after is at a discounted rate, and you go with that. But with these adjustable rate mortgages and everything, you're not necessarily going for the lowest rate at that time and for all time. There is the chance that adjustable rates could actually benefit you going further down the road, right?
Well, for this point in time, with the fixed rates that have gone up, the demand for homes are still there. The problem that we saw is that with the rates going up, if you were supposed to pay $1,500 a month or $1,800 a month, that jacked up to $2,000 something a month, which is much higher. So picking an adjustable rate, for example, let's say you found a home today and you really liked it, and you're able to get an adjustable rate 4%. Now, what you would do is get a fixed rate. You can either get a fixed rate for 5 years or 10 years, depending on the bank you go to, and use that in the meantime while the market on fixed rates are high. And then within a number of years, by that time, hopefully your equity would have gone up, and you bought it, let's say, for 400, and then by that time it goes up to 450 or 500,000. Then you can switch over to a fixed rate. You can reapply for a fixed rate if the rates hopefully will drop back. I think the rates were wonderful when they were fixed, that were about 3% below 4. And then you could reapply for a new loan, an equity loan, and refinance your home. So in the meantime, I think this is happening across the nation. Things have declined a bit, and prices for homes have adjusted a bit. But you know, you could still find something. Buy now with a fixed rate, and then refinance it a few years down the road. So that, for now, rather than put everything on hold, because that special home that you like, your dream home, won't be there, you know, in another few years.
So take advantage of a good deal if the opportunity is in fact in front of you at that moment, but then also realize, right, Gina, with these adjustable rate mortgages, that you could actually, again, you know, you could make this work even better for yourself. So when, I mean, and I know that was kind of a trivial example about myself, about being at, you know, at Gibson's and buying a shirt, but at a more advanced level, I mean, this is also about the mitigation of risk.
Risk and saving yourself some money. I mean,
There.
What we're looking at, I'll give you an example. So if you're on an adjustable, the thing to understand about adjustable rate mortgages is you can pick your term. You could do a 1 year adjustable, so the rate is good for 1 year. After that year, the bank will adjust it. Most of the lenders are telling us they will only adjust it by 2%. So, you know, per adjustment. So let's say the year goes by and you started at 4%. If they adjust it, it's only going to go up to 6%. So it's 6% right now. And right now, based on what the feds are telling us, it's going to go up. It's going to continue to go up through this year. Who knows if that's going to happen or not? That's what we're being told. So that's what we're going to bank on. But let's say you look at a 5-year ARM. So there's 1 year ARM, 3, 5, and 10. What does that mean? The rate is locked in for that amount of time. So let's say you go for a 10-year ARM, because, you know, 5 years goes by fast, 3 years goes by fast. A year, you blink and a year is over, right? So let's say you pick the 10. The difference is on a 10-year ARM, it's going to be fixed for 10 years. Let's say you pick a lender who's offering 4%, and they are out there. I know, I've been shopping around for my customers. At 550, your payment is 2,625. That's just the mortgage and the interest, 2,625. At the current fixed rate interest, which is 6.25, your payment is 3,386. So as you can see, by going with the fixed rate, I mean, if you go on the 10-year ARM, you're saving $786 a month, times 12, times 10. You've saved $94,000 in interest.
And $700 for most of our fellow Guamanians, $700 a month, that's a car payment plus groceries for a family of 3 every month.
Yeah, that's right. Yeah, the old days, and that's why it's important to check the term of that ARM, because I remember I was caught many, many years ago where we had an adjustable rate, and it went up so high that it made it unreasonable in terms of making payment. So the fact that now you have better terms in terms like a 10-year ARM, I mean, that's terrific. And within that 10-year window, you could either sell your property, of course, and by that time it would have appreciated, or you want to buy up, and your monthly payments have not changed in the 10-year window. Mm-hmm. So yeah, the fact that you're getting fixed rate, adjustable rates is a benefit. It's a shorter window than the 30-year, but it's the better alternative for today's market. Mm-hmm. And as Gina puts it, hey, if you're getting the fixed rate at 36 something, 3,000 something versus the 2,200 range, I mean, your choice, you can't miss. You don't want to miss an opportunity to buy the home of your dream, but at least you have options on which loan types to get.
And this is not a rigged system. These schedules and these payments were designed as they were because of, because of economic market factors, obviously, but also to help you, in fact, like you said, get that home of your dreams. I mean, this isn't just like a cheesy sales pitch to separate you from your money. I mean, this is all meant for the customer.
That's correct.
Actually, it's meant to save you money. That's why we're promoting the idea. And Liz pointed out earlier, let's say you lock yourself into a 4% adjustable rate mortgage, but it's fixed for the first 10 years. And let's say 5 years from now, the interest rates drop back down to 3%. By golly, go in there, refinance it, and lock it in at the 3%. There is no prepayment penalty for most of these loans. And you should ask those types of questions at the very beginning when you're working with your lender. Or gosh, just call us and we'll help you through the process. We've done this for many buyers. We know what to coach you and what process you should be going through and what questions you should be asking. And the goal here is we're trying to help you save money.
There, okay. And as we said at the beginning, we'll end with this, right? Let's get some cupcake recommendations, right? It's spring. We're about to go into the Lenten season and everything like that. Liz, you happen to know a thing or two about really, really good baked goods. So what's your cupcake recommendation?
Saucer. What's that one in Tamuning? There's a Perisco, and there's the one. What is that one below IHOP? I go there.
Gourmet Guam.
Gourmet Guam.
Gourmet
Yeah.
Guam. Those are the three I would recommend: Gourmet Guam, Perisco, and Cup and Saucer. Those are the places I would go to.
Well, okay, that's very I was just saying, as long as it's got blueberries, that's what does it for me. I'm an easy guy to please. So what we take away from this, right, ladies, is go investigate the adjustable rate mortgage and go for a good cupcake. A good cupcake will help settle your decision-making process. So ladies, thank you so much.
Hey, happy Valentine's.
Yeah, happy Valentine's. There you go. Yay. Happy Valentine's. Come on, Gina.
Okay, wait. I don't know how to do that there. I did it.
There you go. All right. See you next time, everybody.
House to Home, presented by RE/MAX Diamond Realty.